This is the Hacking Real Estate Podcast, episode 25.
You got to find your edge. It's not just about solving a problem. It's why are you uniquely qualified to go out and solve this problem? And I think if you approach, whether you're opening a little restaurant or, a lemonade stand or you're starting a real estate business, think about that, whether that's, in real estate, the type of product you're providing to residents or to whoever it is that is using your real estate, or if you're launching a fund and you're giving investors exposure, whatever it is, just really go out there, solve a problem, and then most importantly, find your edge in doing it.
Welcome to the Hacking Real Estate Podcast, where we dive into the stories of seasoned, hands-on, and tech-savvy real estate investors. We'll learn the strategies and tools they use to maximize returns and minimize hassle, all while navigating the rapidly changing real estate market. I'm your co-host, Brandon Hall, and managing partner of Hall CPA, and I'm sitting alongside my co-host, Vikas Gupta, CEO of Azibo. With our combined 15 years of experience in real estate investing and entrepreneurship, we're here to help you up your real estate game. Let's get hacking.
Hi, everyone. Welcome to this week's episode of the Hacking Real Estate Podcast. Our guest today is Ari Rubin. Ari is the founder and CEO of Flock Homes. Previously, Ari was a portfolio manager at Ibex Investors, where he led a volatility derivatives fund from inception to $150 million in assets under management. Prior to Ibex, Ari volunteered to serve in the special forces of the Israeli Defense Forces. Ari also attended Stanford's Graduate School of Business and graduated from Harvard College with an AB in geospatial and quantitative history. Ari, welcome to the show.
Thanks so much for having me. I forgot a lot of those things in my bio until you just repeated it, but thanks for the reminder and all that stuff.
Well, one thing the bio didn't cover is a lot about your real estate journey. So why don't you kick us off by telling us more about that?
Yeah. So I think, I started this business 3 years ago. I started actually working on the idea for Flock way before that, back to my days as a derivatives trader. And I really approached this problem. Well, I had some personal experience with it. My parents, as I talk about often, my parents own rental property in Chicago. So I grew up around it. But I started working on the idea actually when I was living in Denver. And I was actually, the idea came to me when I was renting a house in Denver. And my landlord was like most landlords in this country, just, individual investors. The guy just happened to buy a bunch of homes in Denver over the years and had seen such appreciation in the Denver real estate market and was now sitting on this massive portfolio, like millions and millions and millions of dollars of equity. And I approached it from like a risk management perspective. And I was like, this is crazy. This guy is so concentrated in one individual market. I really approach the real estate market, which I think is a good approach to solve whatever industry you're in. I approach it like, I want to solve a problem for this guy. And so the problem that I thought I was solving initially was like, let's help this guy diversify his real estate holdings. I later learned, and I go back in the story more, but that actually diversification was not like a big problem for him, which is why we ended up building, the real problem was like, I'm looking for a retirement solution. And that's what we're doing with Flock, which we can come back to more later. But so I got into this really because I saw this opportunity, the millions and millions of individual landlords out there, not the ones who are starting their real estate careers. I expect many on this podcast are folks who are really starting their real estate journey, and hopefully in 30 years will be that guy, that landlord in Denver, but focusing on folks in the later stages of their careers. And I wanted to build a solution for those folks and solve a problem. And that's what we're doing in Flock.
Got it. Well, I'm really interested to hear about sort of like what you learned from your thesis about diversification and sort of how that ended up not necessarily being a problem. And I guess where I'm coming from is, we've talked to a lot of folks on this podcast, and we have people who have 250 homes or units in one city in Florida. We have people who have homes in multiple cities around the country. We have people who only invest in single family homes in 2 zip codes. We have people who are like, I am in single family and multifamily and short-term rental and in commercial. And sort of it's like there's, one thing I've taken away from this is there's like no one right way to do real estate. And people think about diversification specifically very differently than I think I did, coming from more of a like equities and traditional finance perspective. But I'm curious, like, what was your thesis going in, and like, how did you discover it wasn't a problem, and what did you learn?
Going back a step, like, there's you have an equities background. I come from a derivatives background. There's a famous quote. I think it's Harry Markowitz. He said, "Diversification, Nobel Prize winning economist. Diversification is the only free lunch in investing." Which the idea is diversification is a way to lower your risk. If you put all your eggs in one basket, you have more risk. But if you buy a diversified index of stocks or bonds or cross asset classes, it's a free way, as opposed to like buying insurance, it's a free way to lower your risk. In real estate, that's actually not true, because it's not free, because if you live in Denver and you're just trying to invest, it's actually quite hard. There's a lot of like really cool platforms out there that can help you buy turnkey properties but it's definitely not free if you live in Denver to like go to a new market and invest. And so I think diversification is integral to any investment strategy, but it's oftentimes hard to do that, right? Like if you're going to start with one, like unless you have scale, it's hard to diversify. And again, there's a lot of platforms out there that helps you like invest in a lot of different syndications or specific properties, but there's a lot of fees associated with that, right? And so, when I approached this problem, again, we were focusing on, folks who had owned for a long time. So rather than saying to a young aspiring investor, you should diversify, which by the way, I don't even know if that's true. Again, like if you are boots on the ground, the Des Moines market or the Denver market better than anyone, maybe you shouldn't diversify and buy halfway across the country, and pay the fees associated with it, But so we focused on like the older retiring landlords, and I approached it. And this, I think most folks would agree with, which is like, okay, you've built up like 20 million of equity into like this one neighborhood in Denver, which has, it's gone up so much in value because you just happen to be in this like fantastic place in Denver. Contrast that with Chicago, which is where I grew up and where my parents own a rental property, and everyone I know owns rental properties there, and they've had a very, very different fate. And so I think we can all agree in hindsight, it would have been smart if you lived in Chicago to diversify. In hindsight, it was a good bet, or it was a good play to be concentrated in Denver because you far outperformed. But no one knows, and this goes back to no one knows what the next 10 years, 5 years, or even 2 years are going to look like, right? Even go back to like pre-COVID, or even like right when COVID hit and you saw what happened in certain markets, and now you're seeing what's happening today. And so going back to this notion of diversification, I think we can all agree at a certain point I think we all agree it is good at investing. In real estate investing, there's a certain point in your career where it may make sense to take advantage of. Again, it's hard to do. Furthermore, I think moving forward, and I think this is what I tried to bring to folks is, it's a sound way to own for the long term. I think going back to the original question of like, is this a problem? When I started doing a lot of discovery. So I'd go to landlord meetups. I was listening to a lot of podcasts like yours and just talking to individual investors and mom and pop landlords. And when I would pitch to them this problem of like, you're so concentrated in Denver, people would look at me like I was nuts. It's just like, it was like, yeah, what else would I do? And so I fundamentally believe that a diversified approach is better for the long term, but I wasn't going to argue with these people. Like, they're right. I have a cool idea. And so I very quickly started to do more discovery. And again, this goes back to the point where I started, which is like, I think it's really important to solve a problem. And so I would ask people, is this a problem? And they were like, no, it's not a problem. Like diversification, maybe, I can push rents a little bit more if I have more scale, or I'm less worried about one individual property, something breaking or something. But I really quickly figured out diversification was not a real problem for most individual investors. I will just add though, and this is interesting to see. I don't know where the listener base is, if there's folks in Colorado or in like Florida, for example. If we had a lot of folks come to Flock, and actually this diversification pain point became very real after the fires right outside of Boulder in late 2020. We had a number of owners come to us literally because they lost homes in the fire, and they're like, I own all of my real estate portfolio is in a fire area. Or what you're seeing now in states like Florida or California, which is like, I can't get insurance on my rentals anymore, right? And so I think stuff like that makes people realize like, oh, diversification is a problem. But for the vast majority of folks, we just go along with our normal lives. We collect rents, we look for the next deal, and we just, live the way that, invest the way that we've been investing.
Yeah. So 3 years ago, you sort of did a bunch of discovery, you changed courses. Fast forward to today, you have 500 homes now. Take us through, like, how'd you go from 0 to 500 and what are you doing with those homes?
If you own rental units but don't want to pay for expensive software, check out Azibo, the smarter way to manage your rental properties. With Azibo, you can automate rent collection, find quality renters, simplify accounting and tax prep, get a bank account designed for real estate investors, and save on rental property insurance. All of these services are free through Azibo. Join thousands of real estate investors who trust Azibo to manage their rental business in one convenient platform. Sign up today at azibo.com/HRE. That's azibo.com/HRE.
Yeah. So I'll just quickly explain our model. Like what, we run what's called in real estate, it's the traditional structure is called like an UPREIT, or an exchange fund. And just quickly, if many of you are probably familiar with 1031 exchange, which is a tax-deferred way to roll the proceeds from one home, roll the equity of a sale of one home into another real estate asset. It's kind of a real estate loophole. It is a real estate loophole. It used to exist in art and airplanes and a lot of other stuff. And now I think it's just real estate. We utilize something called a 721 exchange, which is actually not unique to real estate. You can do it in equities. And the way it works is you own an asset. Let's say it's $1 million property. And let's just say for easy sakes, you have no debt on it. And so you could exchange that $1 million, whatever, it can be real estate, stocks, whatever it is, for $1 million worth of shares in a fund, in a REIT, for example, or in an operating partnership. And by doing so, you defer the taxes that you would traditionally realize on a sale, which are capital gains tax and depreciation recapture. And so that's what our model is. We've built, there's a number of exchange funds out there in equities, in real estate. There's also some other things in the 1031 world, something called a Delaware Statutory Trust, which can be good, but is also a little bit complicated. And so the way we scaled our platform, we started in Denver, started with a couple just mom and pop landlords in Denver, and we used the 721 exchange. We said, hey, our pitch to folks, by the way, the structure that we used was the same as day one. I just learned that when talking to folks, I shouldn't call and say, hey, do you want to diversify your portfolio or your home? And like, because people would be like, what's, they would just hang up. I learned, and to sort of brand it as like, you want a seamless, cost efficient exits, defer taxes, continue to, the retirement solution for landlords, which is what we're building. And so we started doing these exchanges, and we started with just 4 landlords in Denver, and just one by one, these folks would come in, they would exchange their house, they'd get back shares in our fund, and we just started scaling it up. And now we're in about 10 markets across the country. Integral. We went from, our first market was Denver. And then once we figured out how to price these things and how to operate these things and really built out like an ironclad system, the next market we launched was Kansas City. Because again, I really fundamentally believe in diversification. And so we wanted to give folks, Denver is historically seen more price appreciation, lower yielding markets. Wanted to give folks more exposure to a market like Kansas City, which was a little bit higher yielding, and have continued to construct a portfolio in that way, which is both high yield assets and then also lower yielding assets in markets like Denver.
Got it. That's really cool. I mean, I think a lot of our listeners are familiar with the sort of like 1031, die, step up, defer taxes forever strategy. This seems like, I guess, go a little bit deeper. Like how is this similar? How is this different? Like, what do I need to know if I'm just very used to thinking about a 1031 mindset about this model?
Yeah. So 1031s is an extremely effective mechanism to generate long-term wealth. Let's just call it what it is. And just for those who don't know, like what it is and like why it exists and why it's effective, in very simple, when you own something and you sell it, if you sell it at a higher price, you owe taxes, and you owe what's called, and by the way, none of this should be deemed as tax advice, but this is just standard kind of overview of tax. So anything you own, when you sell it at a higher price, you owe what's called capital gains tax, right? In real estate, in addition, and that's just on the gain. So from the purchase price to whatever you sold it for, you pay capital gains on that gain. You also pay what's called depreciation recapture, right? Depreciation is great when you own real estate. It's a way to effectively increase your cash flow and lower your tax base. And it's required by law to take depreciation. But then when you sell, it catches up to you, right? And so you have to trigger that. It's not, you don't get away, depreciation, you sell and you later have to, pay that. So what's powerful about a 1031 exchange is you can say, hey, I own these 3 homes, or I own this 1 home. I can sell it and then use what's called a qualified intermediary, which means you never touch the cash. The cash goes through a qualified intermediary. And then within there's a couple different rules of 180 days and 90 days and then 180 days. You have to roll your proceeds into the purchase of another property. So that's great because it's a great way for you who just bought this, who's owned this property for a long time, to continue to build equity without taking this big tax hit, to continue to invest in real estate and get that compounding source of wealth. Because of course, if you took a big tax hit, then it's like, well, now you're starting at a lower base and you can buy less. And so you lose that compounding effect. The problem with 1031, it's great if you want to continue being a landlord, but the problem is like, well, if you want to get out of being a landlord, like you still own real estate, right? And so if your whole goal was to so you can 1031, you see a lot of folks, like they own a portfolio of single families and they want a portfolio into like a triple net or into multifamily. And that's a great solution for many folks. What we hear from a lot of, you're still liable. Like it's still your name on title. You still got to deal with it. You're still concentrated, so on and so forth. And so what the 721 allows you to do, and again, there's a lot of other large private equity firms that do 721 exchanges. What a 721 allows you to do is exchange that asset that you own for shares in a fund. And if you own shares in a fund, you could think of it like owning, interest in a syndication or shares in a REIT. There's some that are publicly traded, that are some that are privately, and so that now you're fully passive. And the beauty of that now, let's say you have a $1 million account, you can say, hey, next year I want to take $50K off the table. And I had a big loss the following year. And so I want to like redeem or sell a couple $100K and tax plan. So or you say, hey, I want to gift 50K or 30K to each of my heirs every single year for the next 20 years, right? So this mechanism is it's a really powerful like estate planning tool, which is why it's why folks do it. I've heard, I don't know if this is true, so disclaimer again, I don't know, but I heard from some professors at Stanford that one of the first exchange funds, or like the largest exchange funds transactions, was actually for Phil Knight at Nike. He owned a lot of Nike stock that he had owned for a long time. He wanted to diversify, obviously, because he had so much of his wealth concentrated in Nike. And so he used an exchange fund. I don't know if that's just a story that Stanford professors tell, but it's an extremely powerful and popular mechanism for that reason.
Well, Phil Knight's a big Stanford guy, right? So that would make sense.
Oh yeah, he's got the Knight Management Center, and he's done a lot of great things for this.
So that's really cool. So you're running this fund, which means you're buying houses. So you have to be able to price houses, and then you're giving up shares in exchange for those houses, which means you're basically having to have like a real-time private market valuation of your entire portfolio. Yeah.
So we basically, when we acquire homes, we do these exchanges, but yeah, we're buying them. Like it's literally there's a settlement statement, and it just, instead of issuing cash, which triggers taxes, we issue shares in our partnership. Sometimes we also buy with cash, depending on where we're at. But and then on an ongoing basis, and exchange funds, they all have different valuation methodologies. What we do, we've sort of emulated a lot of like the largest private single family REITs and how they, in their valuation policies. So we value all the homes in our portfolio on a quarterly basis, based off of third party, what's called AVMs, like automated valuation models. And then we also do a random sampling of appraisals every quarter, and then appraise the entire book every 2 years. And so that's how we value our book. There are some folks who use a cap rate approach, and there's lots of valuation providers. Obviously we get audit, we use a one of the big four audit firms every year. But yeah, valuations are something that can be, I think the trickiest part about valuations is even convincing the seller. So like part of our model is like, we will never negotiate on a valuation. And when we underwrite, we want you to put your house in, but we have a duty to all the other owners who have put their house in. And then we show you as an owner in Flock. And I think this is where at scale, running these funds are complicated. And by the way, if you ever want to launch one, call us. We'll help you do it. We want more folks doing this. It's a really powerful mechanism to aggregate assets. Seriously, call me. But when we underwrite an asset, we never negotiate on that because, again, we have a duty to all the existing landlords, right? And also if we negotiate and we're like, we really like you, then you would be like, wait a second, I don't want shares in this fund. They're just over, so it creates this, and I think it creates a very, like what we call like a very healthy tension where you have the acquisitions guys like fighting with the asset management team of like, no, we gotta, and again, it's a very good way to build a business because we're all working towards the same goal, but you create this healthy tension, which just breeds creativity. And then if you can be transparent about that with your various stakeholders within the business and also with the rest of the market and our owners, our contributors, it's really positive. It's a really positive force.
Yeah, I mean, I can see that being like a really interesting way to hold the line to a seller of, listen, like I could overpay, but then you are then overpaying for every other house that I buy.
And it's like, it creates this really, like in a traditional real estate trend, it's pretty wild. It creates this really interesting dynamic because in a typical real estate transaction, it's kind of a zero-sum game, right? Like not always, like maybe you want to do business with the guy or the gal, somewhere else. You might see him in the local supermarket, so you don't want to totally screw him over. But like there's a buyer and that person's goal is to buy at the lowest price, and there's a seller and that person's goal is to sell at the highest price. With us, you're not only selling your real estate to us, you're also buying shares in a fund. And it's the same thing. And so it creates this like, and you're going to be with us for a while. And so it creates this like, it's a more of a partnership. And I think that's, by the way, that's what I laid out, not just 721 exchange. Can you create that dynamic, right? There's a lot of creative ways to buy and sell real estate, seller financing being one of them, like a joint equity partnership. There's a lot of ways that you can that you can structure deals where there's a lot more alignment of incentives. And I think that's just like it's a much more fun way to work than just a transaction. It's nice to meet you. We never even met. You just sold it to me and then I went, walked off or whatever it is.
So you've been doing this for 3 years. And as we talked about, like valuation is a big part of how you make your model work. It's been an eventful 3 years in real estate and in the macro economy in general. I mean, from your position, like what have you seen change the most over the past 3 years? How have interest rates affected the way that you think about your business? Like what are you seeing? I mean, you're valuing 500 homes every quarter, you're buying homes. So you're in this much more than sort of your typical 5, 10, 15 unit investor who may do one transaction every couple of years.
Yeah. I mean, we see it across, like we've got a whole team dedicated to this and data scientists and outside providers. But I think everyone probably on this also knows their markets because they're watching Zillow or MLS like so regularly. And I think most people here would agree with this statement. Like there's a couple markets where home prices have gone down, right? And some markets where they've gone down, quite substantially. But for the vast majority of markets, like, and Case-Shiller confirms this or would support this, like home prices are really not down all that much. And in many geos, they're actually up over the course of the last year, right? And by the way, we have no idea what the next 2 years will look like. I happen to personally be very bullish on home prices. I don't believe we're going to see the same types of appreciation we've seen for the last 3 years because that was insanity. And that's what happens when there's a lot of money in the system and there's a lot of reason for that. I think one of the things that we see and what kind of worries me in many ways for a lot of transaction-based businesses is, the impacts of the golden handcuffs, right? Like if you bought a piece of, some real estate in the last 3 years with a fixed rate mortgage, which by the way, 90% of owner occupiers have fixed rate mortgages, like you won't sell that. Right. I mean, maybe, death, divorce, like there's a couple things, but for the vast majority of people, I bought a primary residence in Denver that I locked in a 2.6% mortgage on it. And like you could pay me 15% above what I would deem like fair market value, like what comps would support for that valuation, and I still wouldn't sell it. Because if you run the discounted cash flow analysis on like what that thing is going to be worth over the next 30 years, it's just like it doesn't make sense to sell that. And so you see such a wide disparity between like, oh, I own this house, I'm not a forced seller, I've got there's a resident in there, so I'm covering my mortgage with it. I'm not going to sell this thing. And so as a result of that, I think like what we're seeing in the market, both in pricing, as we see prices like largely to be flat to like marginally up in certain markets, San Francisco, and we don't own homes in San Francisco, but I live out here now in the Bay Area, and like you're seeing prices come down a little bit. Markets that, Seattle and Austin are also down, but also they're coming from such like these markets went up, Austin was going up like 15-20% a year, right? And so there's still so much appreciation that many owners who have owned for a long time have seen. And so, in many ways, I think a lot of the pressure that's going on markets, is quite not only natural, but it's like very healthy for those markets to sort of stabilize back to, kind of real world. So that's my quick view on pricing about where we've been and I think where we're going.
Yeah. Fortunately, too bad Brandon couldn't join us today. He is not a big believer in the golden handcuffs theory, so that would have been an interesting debate. Yeah.
Oh, I would love to. Well, we'll have to do that another time because I'll talk to him about it later.
Yeah, I mean, I can give you the quick sort of my understanding of his position, which I think has some merit. I don't think it's like binary per se, but sort of, at least from his perspective, like if you're a primary home buyer, setting aside investment property, but primary home, that it's such an emotional decision. And there's so many other factors that go into needing to move or wanting to move, or what are you buying? What are you selling? That like relative to an investment decision, the interest rate is not nearly as big of a determining factor as to, whether or not you're going to move or sell or buy a house, which I think there's some merit to. I would sort of, my perspective, my thinking is that like on the margin, it has to be affecting people, but that's sort of where he's coming from.
Yeah, I think it's an interesting view. I agree with him at a high level of like, it is so on your primary residence, it's so emotional, or like life happens, like we had to move out to Palo Alto, right? I think where the impact of those, so we moved. But like maybe in an interest rate environment where it's sub 3%, we'd buy. But now in like most markets, it's just like we should rent, right? Like we should be. And then so like we're just going to rent now because it's way cheaper in most markets to rent. Whereas that was different a couple of years ago. In many markets, it was still cheaper to buy. And there is this like pride of homeownership thing, but also like I think our generation sort of, or the next generation certainly views that differently. I think the other part of it, which I'll give a plug to sort of your company, and there's a lot of tools out there that makes it a lot easier to be a landlord now, right? And there's a lot of podcasts that are educating people about real estate investing, right? And so I think it's a lot, as a result of that, you'll see a lot of folks, which I think long-term is very good for our business, because now like you're going to see a rise of the accidental landlords and like, oh, I bought my house in Denver, we had to move to another place, and we'll just rent for a number of years, right? Until because it's 2x more expensive to buy or 3x more expensive to buy.
Yeah, I mean, I think we'll see, right, how it all plays out. Like it's sort of like unprecedented what happened over the last few years. Unprecedented to have, 50-60% of homeowners at like sub 4% interest rates, and how it's all going to shake out, we'll see. And my guess is like everything in real estate, it's all going to be super local market related, and so generalized statements you can probably find proof points for and against in any given market. One thing I want to come back to, sort of at the top of the pod, you had said, diversification is could start to be more of a factor for folks in high climate risk areas where they're having insurance problems. And then sort of, a few segments ago, we talked about how you have this tension between, if you're buying a home from someone, well, then that home is in your portfolio, and you have also a commitment to all your existing homeowners or partners. So I guess like if I'm in Florida and the reason I want to trade in my home is because it's uninsurable, like why do you want it, to be blunt?
Yeah. So we wouldn't take out, like, we can't take one that's uninsurable. So like that person's out. But I think what a better, maybe a way to sort of reframe that same question is like, why would someone who owns an 8 cap exchange, like, we don't own a portfolio of 8 caps. We own some 8 caps, and like 8 caps are awesome, right? Because you get a lot of income. And so the question is like, why would I, if I'm making, 8% in current like net yields, and by the way, people use cap rate, they define it differently. Let's just say like for common definitions, the net operating income divided by the current price. Okay. So just the net yield on the asset. So if you own an 8% net yield home, which by the way is very hard to find in this country because that's not where cap rates are, why would you want to exchange it for a lower yielding portfolio? And we hear this all the time from owners who own in high yield areas. And the answer, of course, is because an 8% net yielding home, again, current net operating income divided by the current price, looks very different than a 4% net yielding home. That neighborhood looks different. The appreciation forecasts look different. A joke that we've heard from many landlords is when that 8% net yielding home goes vacant, there's a high chance that the fridge is not going to be there during the, like when you went during the turn, you're going to lose all your stuff, right? It's a very different asset. And I would make that, so an 8 cap is not better than a 4 cap. It's just different. The corollary we make is like, is buying a high yield corporate bond, is that like better than buying a US Treasury? No, they're just different, right? Like who's the counterparty? What kind of asset is that at the end of the day? One of them is a company that may not exist in several years, and you may not get your principal investment back. And the other one is the US government, which hopefully exists in a couple of years and hopefully get your principal back. And so again, when we think about that diversification element, it all goes back to like, what are you optimizing for? And our goal, like at Flock and the investment strategy and the portfolio that we've put together with, and I'm very upfront about this, our goal is to provide folks with diversified, low-cost exposure to the US housing markets. And so like we don't see 8 caps as better than 4 caps. We don't see, I mean, it's hard to like take a 1 cap, like in Palo Alto, we don't take any of those, but like we don't view the assets as like better or worse. We view them as over the next 10, 20, 30 years, we want to construct this diversified portfolio with exposure to markets like a Kansas City or a Baton Rouge, those types of markets, and then also markets like a Denver and a Seattle, for example.
Baton Rouge is an interesting one. That's got to be a tough insurance market.
It is. Louisiana is very hard. We haven't seen it. It kind of, it all depends. And this is like where so much, there's the national level of how you price. And then there's like the nitty gritty of like, literally, where does that home sit in what submarket? And, you got to be really good on that. That's why when we started, we were really focused on Denver because like, I know the Denver submarket, I know it so well. But then it was like, when we expand to these new markets, we have to be thoughtful about our underwriting, about obviously the boots on the ground in the place, and so on and so forth. So we're not in every market yet, but we've established what I think is pretty good edge in a handful of them.
Very nice. Yeah, we had an episode, actually, I'm not sure if it's out yet. I think maybe it dropped a week or two ago with Sean O'Dowd. I don't know if you know him, but he's launching a fund to buy single family homes in 10 out of 10 school districts. And he focuses solely on the upper Midwest. And he sort of like walked us through his reasoning. And he said he talked to a bunch of larger SFR institutional funds, and they all said that, their exposure on the coasts and in the Gulf is getting crushed by insurance costs. And so they're only looking at the upper Midwest because they think that's the most stable. So that's sort of where that line of questioning came from. I was super curious. All right. Well, I want to make sure we get you out of here on time. And this has been a great episode so far. So I'm looking forward to our 3 standard closing questions. So if you're ready, we'll wind things down. All right. Question number 1. What is your favorite book? And it doesn't have to be real estate related.
Yeah. My favorite book is Let My People Go Surfing, which is the autobiography from Yvon Chouinard, who's the founder of Patagonia. I think it's called like Stories of like the Reluctant Businessman. And I think just the way he's not only built the business, but also lived his life is just, he has a lot of fun. And I think that's so important. And he's built, and I say the word sustainable, and a lot of folks can say take sustainable in a lot of different ways, but like sustainable also of like, let's live a really long life and let's be healthy and let's have fun and let's, and I think he's done that and it shows and it comes out in the product that he's built and he has a true passion for what he's doing. And I do also. And so hopefully it shows.
Cool. I like it. I have not read that one, but I'll put it on the list. Question number 2. In real estate investing, what is more important to you, cash flow or appreciation?
Yeah. So I think my answer, which is like, it all depends on your goals. And I'll answer in a different way, which is even more important than that, is diversification. But actually, like, it depends. If you're young, maybe appreciation and later cash flow. But my answer is diversification.
Well, thank you very much. Final question. Any last piece of advice or insight that you would like to leave the audience with that we didn't get a chance to cover?
I think the biggest one, I started this conversation around solving a problem. I told the story about how I, went out to go solve a problem. And I think the extension of that is you got to find your edge. It's not just about solving a problem. It's why are you uniquely qualified to go out and solve this problem? And I think if you approach, whether you're opening a little restaurant or, a lemonade stand or you're starting a real estate business, think about that, whether that's, in real estate, the type of product you're providing to residents or to whoever it is that is using your real estate, or if you're launching a fund and you're giving investors exposure, whatever it is, just really go out there, solve a problem, and then most importantly, find your edge in doing it.
Great. Well, this has been a fantastic episode. Thank you so much. Before we let you go, give us a plug for Flock and let our listeners know where they can find you.
Yeah. So at Flock, we're building a retirement solution for landlords. So we work with what we call retiring and accidental landlords who are looking for passive income, appreciation, tax deferral, estate planning, and just like total peace of mind, all the benefits of ownership without any of the burdens. A lot of folks out here are probably younger investors and they're starting to build their careers. We work a lot with brokers. If you know folks in your area who you've bought rental properties for along the way and they've owned for 30 years, they're not even thinking about selling. Those are the exact types of folks that we work with at Flock. So give us a call. You can reach me. You can come to our website and put in a property address, or that's the best way, is put in a property address and or find me on LinkedIn, and would love to chat.
All right. And what is that URL?
Flockhomes.com. www.flockhomes.com. Put in your property address. We'll give you a valuation, hopefully within 24 hours. If not, someone's going to hear about it. But yeah.
All right. Well, thanks again, Ari.
Great to see you. Thanks so much for having me on.